Hey everyone, over the last few months when FIs are continuously selling their investment from Indian market, DIIs are actually the net buyers. Now during these difficult times when Indian markets are falling, it is very confusing to identify which stocks to buy because as a long-term investor, we all know that this falling market has created a great opportunity to invest in quality stocks at discounted price for long-term wealth creation. But when it comes to accumulating a specific stock, it gets very confusing because almost all the stocks have tanked badly. So which stocks to add first? Now in this situation, one of the way is to identify potential stock by analyzing the top mutual fund houses. Which stocks are bought by top mutual fund house of India during these downturn? Again, this is not the only way to identify good stocks, but one of the way. So I looked at top holding of top 10 mutual fund house in large cap category in terms of AUM. And I was surprised to see that all 10 out of 10 mutual fund houses have one common stock among their top 3 stock holding. And 9 out of 10 mutual funds have another common stocks in their top 3 holding. And both stocks are from same sector. So in this video, I want to discuss about those 2 stocks. And more importantly, in this video, I want to discuss the reason why everyone is bullish on these 2 stocks. In fact, personally, even I am super bullish on these 2 stocks. Alright, let us look at the details of top mutual fund house and their top 3 holding and identify those 2 stocks. So I have looked at the top 10 mutual funds in India in large cap category as per their AUM and identified their top 3 holding. First mutual fund is Axis Blue Chip that has an AUM of around 34,000 crore. Its top holding include ICICI Bank, Bajaj Finance and Infosys. Second mutual fund is Mira Asset with an AUM of 31,000 crore and its top holding include HDFC Bank, ICICI Bank and Infosys. Third mutual fund is SBI Blue Chip with an AUM of around 31,000 crore and its top holding include HDFC Bank, ICICI Bank and Infosys. Then fourth mutual fund is ICICI Prudential Blue Chip with an AUM of around 31,000 crore and its top holding include ICICI Bank, HDFC Bank and Infosys. Then fifth mutual fund is HDFC Top 100 with an AUM of around 20,000 crore and its top holding include Reliance, ICICI Bank and HDFC Bank. Likewise, I analyzed all top 10 mutual funds in large cap category including your Nippon, UTI, Kotak, DSP and Canara Robeco and found that 10 out of 10 mutual funds have ICICI Bank in their top 3 holding and 9 out of 10 mutual funds have HDFC Bank among the top 3 holding. Now those of you who are only looking for stock tips can skip the video now because now I will talk about facts and you might find it boring. I want to talk about why everyone is bullish on these 2 stocks and banking sector in general. By the way, if you have observed, interestingly all these fund houses do not just have these banks in their top portfolio, but they have all increased their holding in these 2 banks. So the question is why? Why everyone is so bullish on these 2 stocks and banking sector in general? Let's have a look. So there are 3 growth drivers that suggest bright growth prospect in banking sector. First growth driver is revival in economy and strong capex cycle. As per latest press release from RBI, the private sector banks have maintained double-digit growth in credit, which accelerated in successive quarters to reach 15.1% in March 2022. The key reason for this accelerated growth in credit is due to economic revival post-COVID pandemic and rise in capex across industry as well as growth in retail credit. So basically there is an optimism in the economy where corporates and businesses are increasing their capacities. This is catalyzed by rising consumption demand as well as government initiative to boost the manufacturing sector in India. Hence, going forward, private banking sector may see a good growth in their loan books. For example, ICICI Bank loan book has grown from 7.91 lakh crore in FY21 to 9.2 lakh crore in FY22, signifying 16% growth. HDFC Bank loan book has grown from 11.85 lakh crore in FY21 to 14.2 lakh crore in FY22, signifying 19.8% growth. And considering the credit growth cycle ahead, both banks are expected to report good growth in advances. Second growth driver is improvement in asset quality. There was a time in 2016 to 18 when banking sector saw a huge problem of rising NPA, that is non-performing asset. That was the time when many companies went bankrupt, including IL&FS and DHFL. That resulted in sharp rise in NPAs and bank asset quality deteriorated. But over the last few years, banks have seen improvement in their asset quality. This has resulted in fall in NPA. Due to this fall in NPA, banking sector has seen improvement in their profitability. For example, ICICI Bank NPA was 1.14% in FY21, that has now fallen to 0.76%. HDFC Bank NPA was 0.4% in FY21, that has fallen to 0.32%. By the way, HDFC Bank has the best NPA ratio in the banking industry. Going forward, this improved asset quality with lower NPA would ensure high profitability for the bank. Then third growth driver is rising interest rate can benefit banking sector in near term. Now we are all aware that in order to reduce the high inflation, RBI is increasing the interest rate. So far, RBI has increased the interest rate twice and hiked the repo rate by 90 basis points. Now banking sector can actually benefit from this rising interest rate in the near term because majority of loans are on floating basis, that is the loan rates changes as per RBI adjustment in repo rates. So when the repo rate rises, banks also increase their lending rate on home loan, car loan, business loan, etc. However, banks increase the deposit with a lag. They don't increase the deposit rates immediately. Moreover, the lending rates increase is higher than deposit rate increase. For example, ICICI Bank increased the FD rates by just 5 basis points and HDFC Bank FD rates are up 25 basis points. Whereas ICICI Bank increased the home loan rate by 50 basis points and HDFC Bank has increased the MCLR rates by 60 basis points. So basically when there is increase in repo rate, banks increases both the lending rates and deposit rates, but the lending rate hikes are much higher than the deposit rate hikes. That eventually benefits the bank. Another benefit for banking sector is that it is not directly impacted by the rising crude oil prices, just like manufacturing sector. And it is also not directly impacted by slowdown in US economy, just like IT sector. So most analysts are super bullish on banking sector, especially top lenders with solid track record, clean balance sheet, low NPA and high trust among people would benefit a lot from growing prospect in banking sector. On top of this, another reason for having ICICI Bank and HDFC Bank in every fund house top 3 holding is the valuation. ICICI Bank is currently trading at levels of 730 that made a high of around 867 and currently down around 16% from its peak. At current levels, ICICI Bank is trading at a P ratio of 20 and PB ratio of 3.21. HDFC Bank is currently trading at levels of 1375, which is down around 20% from its peak. At current levels, HDFC Bank is also trading at a P ratio of 20 and PB ratio of 3.06. And hence, ICICI Bank and HDFC Bank are great picks in large cap banking sector. Now, if you look at mid cap banking space, I like 2 stocks, IDFC First Bank and Federal Bank. I've already discussed about them in the past. IDFC First has recently declared its Q2 highlights and its deposits have grown by 20.6% year on year. Its CASA ratio stood at 50.3%, which is up 20.3% year on year. Its mortgage business, including your home loan that constitute around 37.5% of retail book, has grown by 31.9% on year basis. Its share price has fallen 50% to current levels of 34 rupee. We can't look at PE ratio of IDFC First because of loss in June 21 quarter. However, its PB ratio is 1.19, which suggests IDFC First is looking very attractive at current valuation. Whereas Federal Bank is trading at levels of 95 at P ratio of 10.2 and PB ratio of 1.22. So looking very attractive at current valuation. Although there is one major risk in the banking system in the short term. The rising interest rate could be a hurdle in credit growth. For example, people might delay their plans to buy a home or car due to increase in loan rate. But it is not that people would just stop taking loans. So there could be some negative impact of rising interest rate in the short term that might discourage people to take loans. And the rising interest rate might impact the profit growth of banks in the near term. However, most analysts are expecting good quarterly numbers from top quality private lenders in FY23. So in this video, we analyzed the top 3 holdings of 10 mutual fund house in large cap category and identified that every fund manager is bullish on ICICI Bank and HDFC Bank. Then we also discussed the reason for the same. There are mainly 3 reasons: revival in economy and strong capex cycle, improvement in asset quality, and rising interest rate can benefit banking sector in the near term. On top of this, the valuation of banking sector is looking very attractive. Friends, it might happen that in the near term there could be some more correction in the stock market due to current issue with inflation in US as well as in India, and that might result in fall in banking sector along with all the sectors. But any fall in the stocks that we discussed would create an opportunity to buy for long-term wealth creation. Just make sure that you invest systematically over the next few months and have a fine balance across categories and sector. Now tell me in the comments, which stock are you bullish on and buying in this current fall? I hope you'll find this video useful. I'll see you next video. Till then, take care.